They told you the crisis was over. Silver bounced 7%. Headlines celebrated the recovery. Institutional analysts called the bottom. But while Western markets were celebrating, China quietly finalized the export restrictions that control 70% of global refined silver. Physical silver in Dubai hit $127 per ounce. COMEX paper contracts still trading at $73? That's a 74% gap between reality and what they're telling you exists. The largest banks just raised margin requirements, not to protect investors, but to protect themselves from something they saw coming. The 7% rebound? It wasn't recovery. It was the last trade before the door closed. Welcome to Daily Silver Crisis. If you've built something in your life, a business, a legacy, a foundation for your family, then you understand that protecting what you've earned requires information others aren't giving you. We'd be grateful if you'd subscribe, not for us, but because the strategies we analyze here don't make headlines until it's too late to act on them. And before we continue, drop a comment below. What city or country are you watching from? We're tracking how this crisis is affecting different markets, and your perspective matters. Let's begin. On February 3rd, 2026, silver prices jumped 7% in a single trading session. Financial news networks called it a recovery. Analysts published notes titled "Crisis Averted," and retail investors who had been sitting on the sidelines began placing buy orders again. The price moved from $73 per ounce to $78.11, and for anyone watching only the COMEX screen, it looked like the worst was over. But there was a problem. While traders in New York were celebrating the rebound, physical silver dealers in Dubai were selling the same metal for $127 per ounce, and they had waiting lists stretching into March. Someone was lying, and the mathematics made it clear who. A 7% gain sounds significant until an observer places it against the 31% collapse that occurred in January, the collapse that erased 4 years of gains in 18 trading days, the collapse that triggered liquidations across commodity futures and forced pension funds to post emergency margin calls. The rebound recovered none of that damage, but it did accomplish something else. It convinced enough participants that the structural problem had been solved, when in reality the structural problem had just entered a new phase. By February 5th, trading volumes during the rebound told a different story than the price action suggested. Volume was thin. Participation was concentrated among algorithmic trading systems and short-term momentum traders. And notably absent were the industrial buyers who typically step in when silver prices fall below production costs. They weren't buying the COMEX contracts because they couldn't get delivery. The exchanges were still settling contracts in cash, offering premium payments to discourage physical delivery requests, and the few participants who insisted on taking metal were facing 8 to 12-week delays that violated standard contract terms. This created an unusual situation in commodity markets, a rebound in price that occurred while the underlying asset became harder to obtain, not easier. In a functioning market, a 7% price increase attracts supply, sellers emerge, inventories move, and the price stabilizes as supply meets demand. That didn't happen. Instead, the rebound occurred alongside declining COMEX registered inventory, which fell another 4.2 million ounces during the same week prices rose, meaning the exchange had less available silver during the recovery than it did during the crash. The numbers didn't reconcile. And for anyone analyzing the market structure rather than just the price chart, that contradiction revealed something critical. The 7% rebound wasn't driven by supply and demand fundamentals. It was driven by forced liquidation exhaustion. When margin requirements increased by 23% on January 28th, leveraged long positions were forced to sell, and that selling pressure continued until those positions were fully closed, which took approximately 5 trading days. By February 3rd, the forced sellers were gone, leaving only natural buyers. And with selling pressure removed, price bounced mechanically. But nothing about the underlying supply crisis had changed. China's export restrictions, announced in stages throughout January, were now fully implemented. Physical premiums in Asian markets remained at historic highs, and Western refineries were running at capacity, but still couldn't close the supply gap. The institutions that issued reassuring statements during the rebound, the same institutions that told investors the worst is over, were simultaneously reducing their own silver derivative exposure in private filings. JP Morgan reduced notional silver derivatives by 18% in the week ending February 7th. Bank of America's commodity desk quietly closed out long-dated silver swap positions with corporate clients, offering early termination payments to exit obligations. HSBC's precious metals trading division implemented new credit limits for silver-backed lending facilities. These were not the actions of institutions that believed in the recovery they were publicly promoting. They were the actions of entities managing exposure to a market they knew was structurally broken. The 7% rebound served a purpose. It reset technical indicators. It cleared oversold conditions. It allowed algorithmic trading systems to flip from sell signals back to neutral. But it didn't change the fact that physical silver and paper silver were now trading in two completely separate realities, with a 74% price gap that couldn't be arbitraged away. Because the arbitrage mechanism itself, the ability to buy COMEX contracts, take delivery, and sell physical metal in Asia, had been systematically disabled, not by market forces, by institutional design. And the rebound gave everyone just enough hope to ignore that fact, until it was too late to act on it. On December 12, 2025, China's Ministry of Commerce published a routine administrative notice, buried in Section 7, subsection 4. A single paragraph mentioned temporary adjustments to refined silver export licensing procedures, effective January 15, 2026. Western commodity analysts barely noticed silver prices didn't move, and the few traders who read the announcement assumed it was standard bureaucratic language with no practical impact. They were wrong. What appeared to be minor administrative paperwork was actually the opening move in a carefully sequenced strategy, one that would systematically remove 70% of global refined silver supply from Western markets, without firing a shot or breaking a single trade agreement. By January 3rd, the first Chinese refineries began receiving export license denials. No explanation, no appeals process, just automated rejections through the digital licensing system. Within 72 hours, Shanghai spot silver prices began separating from London and New York. Not dramatically, just 3% higher. Enough to notice, but not enough to trigger alarm. Industry insiders assumed it was temporary, a political gesture that would resolve after diplomatic discussions. It didn't resolve. On January 8th, China announced Phase 2, existing export licenses, would not be renewed, and all pending applications were suspended indefinitely. The official justification cited domestic industrial requirements and strategic resource management, language vague enough to avoid WTO violations but specific enough to signal permanence. And the timing wasn't accidental. China's solar panel manufacturing had expanded 43% year over year. Electric vehicle production was accelerating ahead of 2027 subsidy deadlines, and semiconductor fabrication plants were consuming silver at rates 22% higher than 2024 levels. These weren't speculative investments. They were operational facilities with locked-in production schedules and supply contracts, facilities that required uninterrupted silver inputs or faced billions in lost output. China chose its domestic industries over Western buyers, and the mathematics made that choice inevitable. A Chinese solar manufacturer generates $87 of economic value per ounce of silver consumed, creates 14 jobs per metric ton processed, and contributes to strategic technology independence. A Western financial institution holding paper silver derivatives generates fee income and trading profits, but produces nothing physical, employs minimal labor, and adds no industrial capacity. When forced to choose, China's government chose production over speculation. By January 15th, when the restrictions officially took effect, the price gap had widened to 12%. Physical silver in Shanghai was trading at $89 per ounce, while COMEX contracts sat at $79. And for the first time in modern commodity markets, the arbitrage opportunity couldn't be executed. Normally, traders would buy COMEX contracts, take delivery in New York, ship the metal to Shanghai, and capture the $10 spread. But Chinese import regulations now required the silver to originate from domestic refineries, making foreign metal ineligible for the premium pricing, which meant the arbitrage window had been closed by policy, not by price. The panic started in Dubai. By January 18th, physical dealers in the Dubai Gold Souk reported unprecedented buying from Indian wholesalers, Middle Eastern family offices, and Southeast Asian industrial buyers, all scrambling to secure supply before the Chinese restrictions rippled through global markets. Premiums over spot exploded from the typical $2 to $3 per ounce to $18, then $31, then $47 by January 25th. These weren't speculators. They were businesses with actual consumption needs, solar installers in Vietnam who needed silver paste for panel production, electronics manufacturers in Malaysia facing production halts, jewelry fabricators in Thailand with orders they couldn't fill. They were paying premiums that destroyed their profit margins because the alternative was shutting down entirely, and China knew this would happen. Internal Chinese government documents, later leaked through industry sources, showed projections from November 2025 estimating that export restrictions would trigger 40-60% price premiums in physical markets within 45 days. The projections were accurate within 8%. This wasn't a reactive policy, but it was a planned deployment. By late January, the secondary effects became visible. Singapore vaults reported net outflows of physical silver for the first time since 2020. Metal was moving from storage into industrial consumption. meaning the buffer inventory that normally smoothed supply disruptions was being drained. Hong Kong premiums hit $53 over spot. London delivery delays extended to 6 to 8 weeks for good delivery bars. And Western refineries, the ones that could theoretically increase production to compensate, were already running at 94% capacity, with expansion projects requiring 18 to 24 months to complete. China had effectively weaponized a resource the West had treated as purely financial by recognizing it as industrial before the West did. The 70% supply removal wasn't just about volume. It was about destroying the assumption that paper contracts and physical metal were interchangeable by making one available and the other impossible to obtain, regardless of price. On January 28, 2026, at 4:47 p.m. Eastern Time, the CME Group issued an emergency notice. Margin requirements for silver futures contracts would increase by 23%, effective immediately, with no grace period for existing positions. The official statement cited increased market volatility and prudent risk management, language that sounded reasonable to anyone not watching what was actually happening in the physical market. But the timing told a different story. 18 hours earlier, 3 major bullion banks had filed confidential position reports, with the CFTC showing concentrated short exposure totaling 340 million ounces of silver, roughly 40% of annual global mine production, held by just 3 institutions. These weren't hedged positions. They were naked derivatives, contracts written against silver that didn't exist in allocated form, banking on the assumption that delivery would never be requested. That assumption was breaking. By mid-January, delivery requests on COMEX silver contracts had spiked 340% above the 5-year average, and the exchange had only 47 million ounces in registered inventory, the category available for immediate delivery. The mathematics was brutal. If even 15% of open interest demanded physical settlement, the exchange would default, contracts would fail, and the institutions holding short positions would face billions in losses as they scrambled to source metal trading at 70% premiums in physical markets. The margin increase wasn't about managing volatility. It was about preventing delivery. Here's how the mechanism worked. A futures trader holding a long position, betting on higher silver prices, must maintain a margin account with the exchange, typically 10 to 15% of the contract value. When margin requirements increase by 23%, that trader must immediately deposit additional cash, or the position gets liquidated automatically. For a speculative trader with 5-to-1 leverage, a 23% margin increase means posting 115% more capital or losing the position entirely, regardless of whether the fundamental thesis is correct. Within 36 hours of the announcement, forced liquidations began. Algorithmic trading systems triggered stop-loss orders. Retail accounts received margin calls they couldn't meet, and even institutional positions scaled back to preserve capital for other trades. The selling pressure was mechanical, not fundamental, but it moved prices just the same. Silver dropped $4.80 per ounce in 2 trading sessions, erasing weeks of gains, and the decline had nothing to do with supply and demand. It was engineered through exchange rule changes, and the institutions that benefited, the ones holding massive short positions, were the same entities represented on the CME's Risk Management Committee, the group that recommended the margin increase. JP Morgan sat on that committee. So did Bank of America and HSBC. The conflict was structural. The entities most exposed to delivery risk were the ones designing the rules to prevent delivery. And they did it through a mechanism that appeared neutral on paper, but neutrality was theater. While COMEX was raising margin requirements and suppressing paper prices, physical silver in Dubai reached $127 per ounce, a 74% premium over the futures contracts trading in New York. That gap represented complete market dysfunction. In a functioning commodity market, price differences between locations are limited by transportation costs, typically 1 to 3% for precious metals. A 74% gap means arbitrage has failed. The mechanism that normally keeps prices aligned across markets has been broken, and 2 separate realities now exist. COMEX contracts reflected the price of paper promises. Dubai spot reflected the price of actual metal. And the institutions couldn't allow those prices to converge, because convergence meant delivery. And delivery meant exposing that the metal backing the paper contracts didn't exist in the quantities claimed. By February 3rd, when silver rebounded 7%, it wasn't because the underlying problem had been solved. It was because the forced liquidation was complete. The margin increase had purged leveraged longs from the market, clearing out the participants most likely to demand delivery, leaving only cash-settled traders and institutional players who had no intention of taking physical metal. With those delivery risks removed, The banks allowed price to recover just enough to reset technical indicators and maintain the appearance of a functional market, but the registered inventory at COMEX continued falling. In the 2 weeks following the margin increase, another 6.3 million ounces moved from registered to eligible status, meaning it was no longer available for delivery against futures contracts. The exchange was simultaneously raising the cost to hold long positions, while reducing the inventory available to settle those positions, while publicly stating that markets were functioning normally. These were not the actions of a neutral clearinghouse. They were the actions of an institution protecting its largest members from a structural crisis those members had created. And the 7% rebound provided just enough cover to keep that protection invisible, until someone started asking why paper and physical had become two different assets, with two different prices, in what was supposed to be the same market. The question facing every business operator in February 2026 wasn't whether silver markets were broken. The evidence made that obvious. The question was what to do about it, when the markets you've relied on for procurement, hedging, and price discovery no longer function the way they're supposed to, and the answer depended entirely on which market you chose to believe. A manufacturing executive looking at COMEX screens saw silver at $78 per ounce, stable, liquid, available for hedging next quarter's production costs through standard futures contracts. That same executive calling physical suppliers in Singapore heard quotes of $121 per ounce, 8-week delivery delays, and minimum order requirements that had tripled since December. Both prices were real, but only one represented metal you could actually receive. For businesses with silver-intensive operations, solar panel manufacturers, electronics producers, medical device companies. This created an immediate procurement crisis. Budgets built on $75 to 80 silver suddenly faced $120 input costs, destroying margins on locked-in contracts, forcing choices between breaking customer commitments or operating at a loss. The companies that recognized the divergence early, in late December when Chinese export restrictions first appeared, began securing physical supply at $85.90 per ounce. They paid premiums that seemed excessive at the time. By February, those premiums looked like strategic advantages. The companies that waited, trusting COMEX prices to reflect reality, found themselves competing for shrinking physical supply at prices 60% higher than their procurement models assumed. Early movers gained 12 to 16 weeks of operational runway. Late movers faced production halts. But the physical procurement problem was only half the equation. The other half involved derivative exposure. Many businesses hedged silver price risk through bank-issued swaps, forwards, and options, contracts that promised to offset physical price movements with cash settlements. Those contracts were written against COMEX reference prices, which meant a company buying physical silver at $120 while holding derivatives that settled at $70.80 had a $42 gap that wasn't hedged at all. The instruments designed to reduce risk were now creating it. And the banks offering those derivatives, the same institutions with massive short positions, were quietly offering early termination agreements, paying businesses to exit contracts before the paper-physical disconnect became legally problematic. A solar manufacturer in Arizona received a termination offer from Bank of America in early February, a payment equal to 60% of the contract's theoretical value, in exchange for releasing all claims. The company's CFO recognized what that offer meant. The bank was willing to take a 60% loss today to avoid a potentially larger obligation tomorrow, when the gap between paper and physical might widen further, or when legal challenges might force settlement at physical prices rather than COMEX references. That wasn't risk management. That was crisis containment. For businesses navigating this environment, the strategic framework had to shift. The question wasn't, what is silver worth? Because that question now had two incompatible answers. The question was, which silver market do we operate in? And the answer determined everything from supplier relationships to financial risk exposure. Companies choosing the physical market accepted higher immediate costs, longer procurement timelines, and the need to maintain larger inventories as buffer against supply disruptions. But they gained operational certainty. The metal they paid for would arrive. Production schedules could be maintained, and customer commitments could be honored. Companies choosing the paper market maintained lower reported input costs, preserved working capital, and kept financial statements aligned with industry benchmarks. But they accepted delivery risk, counterparty risk, and the possibility that when they actually needed physical metal, the contracts they held wouldn't convert at anywhere near the prices they'd locked in. The historical precedent suggested which approach carried less long-term risk. In 2021, when nickel markets dislocated on the London Metal Exchange, contracts were suspended, trades were canceled, and companies relying on paper hedges discovered those hedges were worthless the moment the exchange decided market conditions were extraordinary. In 2000, when palladium spot prices reached $100 while futures lagged at $680, the gap persisted for 9 months, until futures contracts expired and new ones were written at physical market prices, transferring billions in losses to whoever held paper long enough to get reset. Silver in 2026 was following the same pattern. And the businesses that survived market dislocations, the ones that maintained operations while competitors scrambled, weren't the ones with the most sophisticated financial engineering. They were the ones who recognized earliest that paper claims and physical assets were no longer the same thing, and adjusted their strategies accordingly, before the gap became too wide to bridge at any cost. The 7% rebound told you what traders thought. The 74% physical premium told you what the market knew. One was opinion, the other was reality. And in business, reality always wins, eventually.